Here's what's happening at the Walmart in Haishu District, Ningbo. I'm currently on the first floor of the supermarket. A lot of shelves here are empty, which is quite noticeable given the supermarket's large size. It spans 2 floors and has probably been around for over a decade. It's well located too, right in the old city area of Haishu District, Ningbo. Up on the second floor, they mainly sell department store goods, while the first floor focuses on fresh food items. The empty shelves are even more apparent on the second floor. On the first floor, you might see half a row of shelves empty, but on the second floor, entire rows are bare.
As the business environment in China deteriorates, international corporate giants are adjusting their strategies in search of new development opportunities. Following the withdrawal of BlackRock and Vanguard Funds from China, Walmart has shifted its purchasing center to Vietnam. This move by Walmart is a significant realignment in the international market. Chinese media suggests that preparation for this cold winter should be made in advance. The news of Walmart's exit from Chinese market has been widespread. Although Walmart has not yet given a definitive response, the visible reduction in the number of its stores is evident to the general public, with one store after another closing down. It is reported that Walmart's Lianfen store will cease operations by the end of November.
Walmart, a global giant, seems to be outperforming all of China's e-commerce and brick-and-mortar supermarkets. But despite this, Walmart is facing challenges in the Chinese market. In 2023, while Walmart achieved a global growth in sales, profits, and store numbers, it saw a wave of closures and market contraction in China. Over 140 stores in China have been shut down, mainly due to lease expirations and high rents. Another reason is the unexpected complexity of the Chinese market.
Amidst a growing wave of store closures, news has emerged that Walmart is relocating its purchasing center from China to Vietnam. On November 17, a well-known financial blogger and professional investor on Weibo known as Financial Little Fox posted a significant signal: Walmart withdraws from China, moving its purchasing center to Vietnam. Another giant departs from BlackRock and Vanguard. Should we prepare for this cold winter? The news has shaken the market. The article states that Walmart's move to Vietnam not only signifies a strategic shift, but also foreshadows a change in the competitive landscape of China's retail industry. It raises questions about whether Vietnam will become the next world's factory and the impact this will have on China's manufacturing industry. According to Vietnam's Ministry of Industry and Trade website, on November 15, Andrea Albright, Walmart's Executive Vice President of Sourcing, stated that Walmart's future strategy includes making Vietnam a regional commodity supply center in Asia. Albright noted that Walmart currently imports billions of dollars worth of goods from Vietnam each year and plans to expand its procurement of Vietnamese home goods, electronic equipment, and various toys. Walmart, the global retail king, has topped the Fortune Global 500 list for 9 consecutive years. In the past year, Walmart's total revenue amounted to 3.87 trillion yuan, comparable to the GDP of some of China's largest economic provinces. Since entering China in 1996, Walmart had a period of rapid expansion, opening more than 40 stores annually. During its most prosperous period, the term Walmart's 5-kilometer death circle was coined in the industry, implying that other supermarkets had no chance of survival within a 5-kilometer radius of a Walmart store. Now the pace of Walmart store closures in China has noticeably accelerated. According to Chinese media, from 2016 to 2022, Walmart closed over 130 stores in mainland China. Some may argue that Walmart's departure is an isolated case. However, it should be noted that this is not a solitary occurrence. Due to the trade friction between US and China, along with the impact of China's zero-COVID policy and geopolitical influences, foreign companies are increasingly focusing on the security and resilience of their supply chains, rather than efficiency and profit. In the past 2 years, these multinational corporations have been leading the shift and restructuring of industrial chains. Especially against the backdrop of China's continuing economic slowdown and Beijing's tightening national security reviews on businesses, foreign enterprises face heightened business risk, prompting many to withdraw from China. Recently, there have been reports that even BlackRock is planning to sell its assets worth tens of billions of yuan in China. According to the Chinese media outlet, The Paper, on November 18, sources revealed that BlackRock is looking to relocate its funds to projects with better investment returns and has already found prospective buyers. Reports suggest that BlackRock's planned sale includes logistic assets in 11 cities such as Dragoncore Nanjing Binjiang Cold Chain Logistics Park, Dragoncore Guangzhou International Airport Logistic Park, Dragoncore Foshan Nanhai Logistic Park, Wuhan Lensheng Logistic Park, and Dragoncore Qingdao Port Logistic Park, covering a total area of 2.2 million square meters with an average occupancy rate of about 80%. The paper quotes analysts saying that while investment firms might quickly flip smaller projects, it's unusual for BlackRock to sell large-scale transactions like the Guangzhou International Airport Logistic Park within less than 2 years of acquisition, as typical long-term investments don't happen in such short timelines. The report also noted that BlackRock's sale of logistic warehouses assets is not the first instance of the group making a bulk sale. On June 28 of this year, BlackRock sold approximately 1.3 million square meters of industrial real estate to logistics infrastructure operator Prologis in a deal worth $3.1 billion. Prior to BlackRock's bulk sale of logistic assets on November 15, the leader of China and the United States, Xi Jinping and Joe Biden, met in San Francisco. That evening, Xi Jinping dined with Silicon Valley and Wall Street business magnates, including BlackRock CEO Stephen Schwarzman. Zheng Guoqiang, executive deputy editor of Taiwan's Crederi Media, recently wrote that Schwarzman, the founder of BlackRock and a long-term friend of China's former vice president Wang Qishan, was seeking important information by attending Xi Jinping's main table. His decision to sell the 11 logistic parks in China immediately after dining with Xi Jinping indicates that Xi did not provide the answers the businessmen were hoping for. The analysis suggests that Schwarzman is still uncertain about the Chinese Communist Party's current economic decline, viewing the sale as a statement of his lack of confidence in China's foreign trade and economy.
There are a couple of reasons for this. First, the real estate situation in China is precarious. October's data from the National Bureau of Statistics of China showed the biggest drop in house prices in 8 years, indicating a continued slump. Blackstone Group's recent sale of 11 logistics parks, all real estate investments, was a forced move. Second, the uncertain geopolitical relationship between China and the US. Despite recent high-level meetings, there was no significant outcome, and the fundamental competitive tension remains. The recent trends in China's A-share market reflect that the meeting didn't meet investors' optimistic expectations. Blackstone's massive sale of assets in China is seen as a move to hedge risks.
Additionally, Gallup, a globally renowned business market research and consulting firm, recently informed its clients that it would be shutting down operations in China, withdrawing from the country, and recommending clients to relocate some projects to outside of China. Consequently, several of the company's projects will be cancelled. It's not just consulting companies. Vanguard, the American asset management giant, is also taking final steps to exit its business in China. According to a Bloomberg report, insiders revealed that Vanguard has signed a termination agreement with about 10 remaining employees in Shanghai, with most team members set to depart early next year and the office to close. Official Chinese statistics showed that by the end of September, foreign enterprises had withdrawn more than $160 billion in capital from China over 6 consecutive quarters, a massive outflow of funds almost unprecedented in history. In the third quarter of this year, this surge in capital withdrawal led to a negative amount in China's foreign direct investment, a first in nearly 25 years. The Economist reported that foreign investors withdrew more funds from China than they invested, through repatriating profits, repaying intra-company loans, and selling assets. The Economist pointed out that this reversal may be a reflection of the delusionist of foreigners with China's economic prospects and policy making. The Chinese government's overreaction to the COVID-19 pandemic, regulatory crackdown on technology companies, and investigations into foreign due diligence firms like Bain, Capvision, and Mintz have unsettled many investors. Many foreign enterprises are looking for better avenues for their capital and rethinking their supply chain outlets. The deteriorating business environment in China is closely related to this shift. Xu Chenggang, a senior research scholar at the Stanford Center of China's Economic Institutions, recently wrote that the current economic development situation in China continues to decline. In addition to systemic issues, China's two main drivers of economic growth, private enterprises and globalization, have been damaged. He commented that China has single-handedly weakened its private enterprises and disrupted globalization. This has led to an acceleration of foreign enterprises' withdrawal from China. Regarding globalization, Xu Chenggang stated that the underlying reason is still the system. The fundamental reason for the deterioration of Sino-US relations is the past failure of democratic countries to understand the communist authoritarian system. They may not fully understand it now, but they are starting to feel it. He added that an important part of the deteriorating relations caused by the system is Xi Jinping, the leader of the Chinese Communist Party. Many people think that the issues are brought about by the Chinese Communist Party leader, but the way the party leader acts goes beyond its personal capacity. He is the leader of the Chinese Communist Party, and he does what the party wants. Zheng Shugan, a political economist based in the US and a host of the Shugan Times commentary, believes that not only foreign capital, but also Chinese capital is withdrawing. In the long-term layout of the mid- and low-end manufacturing, it will inevitably move to places with cheaper labor. Furthermore, the geopolitical competition between the US and China means high-end sectors are destined to be suppressed. In order to avoid that, businesses need to be free from constraints of Chinese companies such as Singaporean enterprises. Zheng Shugan said that China's aging population, capital outflow, and competition within the US are all set facts. Even if China's leaders are replaced, the US will still contain China's technological and military development. Additionally, the diminishing returns of capital in China's development cannot be changed. He concluded that the West has also awakened, realizing they had been severely deceived in the past. The Chinese Communist Party never intended to pursue peaceful evolution, and now their intentions are clear. The party state has made it clear that it does not wish to change.